But with the lump sum strategy, if you manage to get the timing reasonably right during a significant downturn,
Big if.
huge if. But if you do, you lock in a much larger number of units at that low price point, so the potential for higher absolute returns is definitely there.
It's a higher risk, potentially higher reward situation versus the steady as she goes SIP.
That's a good way to put it. It's a trade-off.
Yeah.
Timing the market is notoriously hard.
So speaking of timing, how would someone even try to spot these downturns?
No, definitely not. Our source mentions watching a few key areas.
Mm-hmm.
First, the big economic indicators.
Like GDP growth, unemployment.
Yeah, GDP, unemployment rates, inflation figures. If you see GDP falling consistently and unemployment rising, that could signal weakness ahead.
Okay, makes sense. What else?
Market sentiment is another one. What's the general mood? Reading the news, seeing what analysts are saying, how other investors seem to be behaving. Lots of fear can sometimes signal we're near a bottom.
The be greedy when others are fearful idea?
Sort of, yeah. And then there's technical analysis.
Looking at charts and trends.
Right, using historical price data, chart patterns, trend lines to try and spot potential reversals or confirmations of a downturn, like breaking a long-term support level maybe.
Okay, so it's not just one thing, it's piecing together different signals.
Exactly. It requires staying informed and, forming an educated view, not just guessing.
So wrapping this up then, this deep dive suggests that, putting a large sum into mutual funds during a market dip can be a powerful way to build wealth.
It has that potential, yes.
But it really hangs on a few critical things. One, having the psychological strength, the nerve to actually do it when everyone else is scared.
Absolutely key.
Two, understanding that historically markets do tend to recover eventually, even if it takes time.
That historical perspective is crucial for conviction.
And three, making an informed decision, not just a wild guess, based on watching those economic and market signals we talked about.
Well put. And it's not about perfectly timing the absolute bottom. That's almost impossible.
Right.
It's more about recognizing when things are significantly cheaper than they were, when valuations look attractive, and having the confidence to act, understanding that recovery is, historically speaking, the more likely long-term outcome.
Definitely gives you something to think about for your own investment approach. How does this idea fit with your own tolerance for risk, your view on market cycles? Maybe do some research on past downturns and see how they actually recovered.
Good thought. Seeing the data yourself can be powerful.
Thanks for exploring the strategy with us today.